Most businesses don't run out of revenue, they run out of timing. The deals close, the invoices go out, sales look strong, but the bank account tightens. And when that gap gets ignored, even profitable companies start to feel unstable. If you're a founder or operator, this matters more than growth strategy, because strong revenue can hide weak liquidity discipline. And when decisions move faster than cash conversion, pressure builds quietly. By the end of this video, you'll understand why cash flow stress is usually a sequencing problem, and how to control it before it controls you. Most founders believe cash flow problems mean one thing: we need more sales. That belief makes sense. Revenue feels like proof the business is healthy. When stress appears, the instinct is to push harder, increase marketing, close bigger deals, accelerate growth, and sometimes revenue is increasing. You might even be hitting record months. But here's what happens at the same time. You hire additional staff. You upgrade systems. You increase ad spend. You expand operations. You commit to long-term tools or office space. Individually, those decisions are rational. Collectively, they increase fixed pressure. Then the symptoms begin. You monitor receivables more closely. You delay vendor payments by a few days. You hesitate before approving expenses. You feel tension before payroll. Revenue hasn't collapsed, yet liquidity feels unstable. That contradiction is the signal. 1. Revenue is not liquidity. Revenue is recorded when the deal closes. Cash flow changes only when the money hits your bank. If your payment terms are 30 to 60 days, there's a structural gap. During that gap, you are exposed. When you make commitments based on signed contracts instead of collected cash, you're spending future money. On paper, you're profitable. Operationally, you're dependent on timing behaving perfectly. But timing rarely behaves perfectly. Clients delay. Transfers stall. Unexpected expenses surface. Taxes arrive. A 10-day delay across multiple invoices can compress liquidity dramatically. Not because sales dropped, because arrivals shifted. That shift creates stress. 2. Fixed cost expansion shrinks flexibility. Growth often increases fixed commitments. Payroll, long-term subscriptions, leases, retainers. Fixed costs don't adjust when receivables slow down. Once added, they compress your margin for error. A business with low fixed overhead can absorb timing volatility. A business with high fixed commitments cannot. The higher your structural obligations, the more sensitive your company becomes to timing drift. Revenue can still look strong, but internally, flexibility declines. That's where fragility begins. 3. Decision momentum outpaces. Cash conversion, strong months create confidence. Confidence accelerates decisions. You think, we're growing. This is the time to scale. Let's invest. None of that is irrational. The issue is sequencing. Revenue growth and cash conversion speed are not identical. If revenue grows 20%, but fixed commitments grow 35%, your exposure increases. If receivables lag even slightly, liquidity tightens. Over time, this creates a cycle. Strong sales, confident commitments, delayed cash, short-term stress, recovery, repeat. Founders often interpret this as normal volatility. It's not volatility, it's misaligned timing. Let's walk through a simple scenario. A business closes $150,000 in revenue in January. Payment terms are net 45 days. That means most cash arrives mid-March. Encouraged by performance, in February the founder hires a $7,000 per month operations manager, adds $6,000 in monthly marketing spend, commits to $4,000 in new software and systems. That's $17,000 in new monthly fixed costs. Before this expansion, monthly operating expenses were $90,000. Now, they're $107,000. February bank balance shows $60,000 in available cash. January receivables are still outstanding. In March, 2 major clients delay payment by 15 days. That's $30,000 expected mid-March, now arriving in early April. Meanwhile, payroll runs, marketing bills hit, software auto charges, rent is due, revenue hasn't disappeared, profit margins may still be healthy, but timing shifted, and that shift creates a temporary liquidity squeeze. The business didn't fail because of weak sales. It tightened because February decisions were made based on January invoices, not February cash. That is decision timing exposure. To regain control, founders need structure, not more revenue. 3 principles. Principle 1. Separate revenue from liquidity metrics. Never treat invoiced revenue as usable cash. Track these separately. Revenue closed, revenue invoiced, cash collected, fixed monthly commitments, cash runway. When you merge these into one mental number, visibility disappears. Liquidity discipline requires its own dashboard. Principle 2. Sequence commitments. After cash conversion, hiring and structural expenses should follow cash realization, not sales announcements. This doesn't slow growth. It stabilizes it. If receivables are predictable and timely, commitments become safer. If receivables are inconsistent, commitments should lag slightly behind. This buffer absorbs volatility. Without it, growth becomes fragile. Principle 3. Stress test. Every major decision, before approving a significant expense, ask if 20% of receivables are delayed by 30 days, does this decision still hold? If the answer introduces tension, the timing is wrong. This single question protects liquidity without killing momentum. It forces clarity. If decision timing remains misaligned, several things happen over time. You rely more on short-term credit. You operate with minimal liquidity buffer. You feel reactive instead of strategic. You hesitate during genuine opportunities. Personal stress increases. Externally, the company may look successful. Internally, it's fragile. Fragility limits optionality, and optionality is what gives founders control. Revenue drives expansion. Liquidity determines stability. Most cash flow stress is not a sales problem. It's a sequencing problem. When you align commitments with actual cash timing, pressure drops immediately, not because growth slowed, because exposure narrowed. Control the timing of your decisions relative to cash arrival. That's where stability begins. If you value structured breakdowns like this, focused on financial control and operational clarity, subscribe for more strategic insights on building durable businesses.